Hey guys, welcome to part 2. So in part 2 now we'll enter into the powerful tool that we have been talking about. So this tool is actually called finviz.com, which you already have. So how you want to access this, and this is what we want to access, right? So first and foremost, go to your Chrome page, type for example finviz.com. So let me just open up a new one over here. Very quickly open up a new one. So first and foremost, go to finviz.com, finviz.com. Then you go over to this, hover over this button called groups. You can actually enter these groups here. Now once you press on this button, you'll come to this page, which is exactly the page that we are showing you just now. You can see the 1 day performance by the sector, the 1 week performance by the sectors, 1 month performance, 3 month performance, 6 month performance, 1 year performance, and year to date performance. Now we are very concerned over the past, one week to 1 month, because that's the month of May, right? And that's where all the volatility happened. And we will still want to find out which sector is the one that actually still stayed up, because all the sectors went down, especially technology went down a lot, right? So we want to find out which sector is the one that we should be hiding in that's actually doing well and not losing money. I mean, it's losing money, but not losing as much money. So let's take a look at this performance that Finviz really break it down for us. We can see that conglomerates are actually doing very well. Basic materials are doing very well. This is on Friday. On the 1 week performance, you see that utilities did exceptionally well. It's one of the highest, better performing, is the best performing sector across all industries. We have healthcare also doing relatively well. We have financials that just break even for you. So that's some place you can hide. Financials are stable. You can hide there. You can hide at utilities. You can hide at healthcare. So we also look at the 1 month performance to see similarly that utilities and healthcare are still the companies, the sectors that are doing well. Whereas you see other companies like conglomerates are actually getting crushed, whereas the 1 day performance is very bad. So we are just looking specifically at the 1 week to 1 month time period because we want to find out which one is the better one for us to actually enter into, which sector is better for us, right? So we can see down here that we are actually more into healthcare, and that's why we're actually into utilities and healthcare, but for this case study wise, we're going to be more onto the healthcare sector because we feel that it's a better performing sector. So let's just say, for example, we're into healthcare. So what can you do? You can simply just go over to screeners. Alright, you're going to look for healthcare stocks, right? So you can just simply go to descriptive here, just go to sectors. You can change it to healthcare, right? If you're into utilities, you can also change it to utilities over here, right? But for this case study, we're doing to healthcare. So we can see, okay, let me just show you guys. Initially, there's over 7,000 stocks down here, all right? We filtered it to just healthcare. When you filtered healthcare, you can see that it actually changed just to 879 stocks only. Now, this is things that it will cut down like 10 times for us already. So what we're going to do now is to filter for stocks that actually relatively better performing ones. So when you look at the fundamental section, we want to see some things that, first and foremost, very straight up, we want debt to equity level less than 0.5, right? Because this is very important. We don't want to have a company that's high in debt. So we can see now it narrows down to 594 companies already. Then next, we want gross margin. We want gross margin to at least be positive, right? Because you wouldn't want to invest in a company that's not positive. Or likewise, you can actually put it, if you're more strict, you can go it for over 40%. Right, you can go for over 40%. It narrows down to 179 stocks left, right? After which, what you want to see is EPS growth within the past 5 years. Now, some people say you want to put EPS growth at over 20%, etc. I mean, that is true. That can be possible. Meaning to say that you want the EPS to be growing 20% consistently. But what we are trying to put is we want at least the EPS to be growing and not be stagnant at all. So that's why we put positive. So it's actually better for us. Then next, we want to also look at companies that are actually growing relatively to its PE ratio, right? So we also look at the PEG. We want it to be less than 1. Why? Because less than 1 suggests that the company is growing very fast and the price to earnings ratio is relatively low. That's why it's able to get 1. Alright, less than 1. So when we go for it 1, we can see it actually break down to just 8 stocks left, right? So right now we see that we have companies from US, Hong Kong, US again, and we have all these companies over here. Now we want to sort it by market cap first. Why? Because we want to make sure that the company is relatively big and it's not just a small scale company. If it's a small scale company, it's considered a micro stock, micro cap stock, and those are things that we do not actually want to be going for. So we're going for a relatively stable company, and we can actually look at this company called Axis, right? You can see here it's $6 billion. It is the second highest one within all these performance, all these criteria over here, second biggest in market cap. And the best part is the PE ratio is below 12. It is simply at 9.78. Now we take a look at the price is $20. So when we take a look at it closer, we can enter into it. I think I have it here. Do I have it here? Okay, no. So I will just probably open up one more tab here. So we open it up here. We can see that there is this stock is actually we can see everything about this stock over here. We can see the price to earnings, the forward PE, the PEG is just 0.21. There is debt to equity level is 0. Everything's good. What we can do further is we can also go to Morningstar. So let me just open up a new one over here because my face is being blocked there. So Morningstar EXO. So we go to Morningstar EXO. Yeah, if you are new to it, you can just simply do what I do, Google Morningstar EXO. You can straight see the financials of the company. So we want to see the key ratios and every single thing of the company. We just simply go to key ratios down here, key ratios data over here. So once you're in, you'll see all of these things. You can see the EXO has been increasing their revenue over the past few years. The gross profit margin has been stable around 80 something. Lowest it goes 89.5%. We see that the net income has been negative over the past 8 years, and recently has been coming up. So why is it so? That's for us, and that's for you to find out and us to know also. So being said that, right, the EPS will also be negative coming towards positive. So you're gonna find out why is this company net income negative, right? What we can do is we can simply go over to their website over here. So when you come to website exodus.com, right, you can see that they are more of a pharmaceutical industry, a biotech company that is actually focused on creating what we can see down here straight medicine, and straight we can see research and development pipeline. So that explains why the company is losing money initially, because they are heavily invested in R&D, right, to actually research for drugs, research for elements that can potentially benefit humans. So when you take a quick scroll down, you can see that the overall strategy is going about cancer. Cancer is our cause. Go further down, tackling difficult to treat cancers. So they're going full on out on heavy cancer treatments, right? And you can see that in the past few years, the first 8 years, they have been suffering like crazy. They have been losing money like crazy. But in 2017, we see developments in the net income, right? So it's actually something we should be aware of. And if you take a look at the free cash flow per share, it goes to show that the R&D is currently paying off, because they currently host free cash flow now, meaning to say that maybe they have sold some stuff and they have more cash. The pipeline was actually successful. They have sold some stuff, right? They have more cash. They kept it, and even after they put in some money for R&D, they still got free cash for themselves. Then when we scroll down, we can see that the return of equity is relatively high, so let's not trust the number. The return of assets is super high, so we're not going to trust the number. We're going to stabilize a bit first. But we also want to take a look at, for example, the financial health. We can see that the debt to equity ratio is, as mentioned, 0. Previously, they did have debt, and now they have 0 debt. So that's relatively good. That's something that we're looking at. And this is EXO. So this is a very, very quick, analysis on EXO that you can actually potentially look up into, find out more about their pipeline, find out more what happened in 2017. The drugs went through, they had a huge breakthrough or something that actually make them in a positive net income. So that is your homework for today. All right. Then also we like to share on how you can actually take advantage of other healthcare stocks, right? So what you can do is simply you can actually go to, you see here that down here is this button called Maps. Right, I want you to click on this button called Maps. Let me just close all these first. Close all these first. Okay, so you see this button called Maps. You see a huge, map. This is what we which is what we call Maps, by the way. So when you want to look at exchange traded funds and look specifically for the healthcare industry, So we see down here, there's a US, there's large cap, there's international, there's US sector, and then we look at here and it's healthcare, right? But this is the 1 day performance. We're looking for a 1 month performance. So we change it over to 1 month performance, and here we have here a breakdown for us. The bigger the box, the higher and the bigger the market cap or market share it is, right? So when you look at this XLV, we can actually see they actually have all of these stocks over here. Now what we want to do is we want to click into it, double click into it. We can open up a Finviz healthcare on it. We can open up, you look at the charts, look at some basic information about it, right? So what we want you to do is actually press on this thing called statements. Now we press on statements itself, it brings you to another tab, right? It's called marketwatch.com. It tells you the key data of it, how much is the total net asset of this healthcare ETF is 18.29 billion. It gives you a 1.57% dividend yield, and you also have an expense ratio of 0.13%. 0.13 is less than 1%, meaning to say for how much money you make throughout the year or how much money you lost throughout the year, they will still give you a 0.13 expense ratio. It's like an administration fee. They will just cut it off from your own stock investment there. So you'll probably lose a bit of money if the stock doesn't do well, the ETF doesn't do well. But ETFs, fund managers are always motivated to break the stock higher. So don't have to worry about that. Let them worry about that. Now you just see that they actually go below and it shows you how much your dividend distribution year to date, what's inside this particular ETF. We have Johnson & Johnson, you have United Health, we have Pfizer, you have Merck, we have Abbott Laboratories, all these companies that are doing very well in the healthcare sector. Then we also have this thing of the biotech, right? When you look at this, the XBI is a biotech sector that you can look at. Similarly, you also want to press the statements over here. When you press statements over here, you come over to here. So you come over to here as SPDR S&P 500 Biotech ETF. So when you scroll all the way down, you'll see the same thing. This ETF is much more diversified. Why do I say so? Because the largest holdings, these are the top 10 holdings by the way. The largest net asset holding is Johnson & Johnson, 10.72%, whereas this one, the largest holding is 1.8%. So you can see it's a relatively more diversified ETF, but then it is a little bit smaller. Why? Because its net asset is just $4.27 billion and an expense ratio of 0.35%. So some things that you may want to look at before investing in a specific sector ETF. But ETFs are good to hide when the overall market is coming down, because you're looking for safety, you're looking for a cushion, you're looking for a diversified portfolio, and ETFs fulfills all of these criteria. Alright, so I hope you guys learned something from today's this specific segment on how to hide, and I'll see you in the next video where we'll talk about candlestick movements, charting and analysis. Alright, so see you there. Bye bye.